Okay, I'm going to make a short and sweet version of a longer presentation I have around what investing we do and how we do it. So our goal is essentially to retire from our stock market portfolio growth and to end up with the growth that we can buy a dream house. Our stocks are only part of our investment, and most of our current value is in our house in Sydney, which is unrelated to our stock market growth. So that's even if our stocks crash, we still have some money. Our plan is basically just to buy some stocks, wait for a few years, and then start selling a few percentage of them. And then eventually, when it grows big enough, take out a big chunk and buy a house. We have simple rules for when to take money out. If when our stocks are worth less than 500K, we don't. When between 500 and a million, we take out 100K a year. And when they're above a million, we take out 280K a year. So let's look at an example of how this might play out. If we had put in 100K in 2011, there it is, 100K. We would have had to wait 5 years for it to get to 500K. And then in 2016, it would have grown all the way up to 800K. We took out 280K, leaving us with 600K. Next year, similarly, it grew up to a million. We took out 280K, leaving us with 700K. The next year, it shrank back down to just above 500,000. So we took out less, 100K. Next year, similarly, only 100K. Next year, it hit a million again, but we were nervous, so we still only took out 100K. Next year, it grew a lot more, almost 2, so we took out our full 280K. Ooh, shrank that year, back down to only taking out a little bit. And 2023, it grew a lot, so we took out our full amount. That was a pretty aggressive taking out of money. We took it out quite early, and that ended up being a big percentage of our portfolio. So here's a more conservative model. We wait until it grows all the way to 3 million. Then taking out 280K basically doesn't matter because the market moves much more than the amount we're taking out. What is in our portfolio? It's basically a bunch of tech stocks. At the moment, it's a ton of NVIDIA. It didn't used to be that much NVIDIA. But it's Apple, Google, Microsoft, Amazon, and a few other non-tech stocks. Here's how they actually did with a real investment. The previous thing was hypothetical. You can see that it grew 75% over 3 years. Here's how the historic performance compares to real estate of various kinds. You can see it massively outperforms every kind of real estate. Also, the typical NASDAQ or a Vanguard fund. How do we deal with the risk? As you saw, it changes wildly. It's every year. Some years, this light green bar shows it dropping 50%. Other years, it's growing 100, 200%. What we do is that's why we wait 5 to 10 years. This blue bar here, you can see, doesn't vary much. That's if you buy any random 10-year period and wait 10 years, it grows at least 24% every 10 years. Sorry, 24% average annual growth over any random 10-year period. Again, the single year returns compared to Vanguard are much higher on good years. We do have bad years just like they do, but our good years are much better, so our average is much higher. Okay, so basically the hard part of this strategy is that you have to kind of ignore what's going on year to year. You have to be able to sleep well at night with any investment. So how we do it is we realize what we're doing, which is we're investing in the logarithmic growth, the doubling of the NASDAQ over a very long period from 1987. It's been doubling. We think that'll continue doubling. So that requires us to focus on a long-term, like 5 to 10-year strategy and ignore what's happening year to year. That's harder to actually do than it is to say, because you feel either rich or poor as your market value jumps all over the place. But if you can just ignore what's happening year to year and stay on your 5-year target, you'll be fine. That's how we explain it to ourselves. The other tricky thing is that it's an exponential growth, which means it's slow at first and then suddenly fast is how it feels to humans like myself. So you just have to be patient for the first few years. Okay, so if you wanted to do this, here's the decisions we made. First, we decided how much to invest. Then we decided how long we want to wait or can stand to wait given our age and everything. And then the third thing is what amount to start in harvesting. So if you can't wait 5 years, you shouldn't do this strategy at all. So how much to invest? Basically, obviously, the more you invest, the more it'll grow. But there's something to be said for investing less and waiting longer if you have the time, because it lets you average over various years and get it's safer essentially. In this example, if this person had invested 200K in 2015, they'd get the same outcome as if they invested 100K in 2011. So when to harvest? Basically, when the amount of your portfolio is so big that the amount you're taking out is kind of insignificant. That's in this example. There's a bunch of other decisions that you'll be faced with, and they don't matter much for this strategy. For example, you can just invest all at once, or it's a little better to do it a chunk at a time, like, some every month for a year. But whatever, it won't matter much. When to buy? If you're waiting 10 years, it doesn't matter much. The minimum and maximum range, I'll show you in a second, aren't that different. So, and which stocks, you can pick your own. Basically, just look for any stocks that return at least a 30% average annual return over a 10-year period. Or you can just copy what I did. The longer you wait, the less luck matters. In other words, the stock market feels random, like gambling. But if you wait long enough, the trend emerges. So this shows that the worst 10-year period on record since 1992 would have returned you 24%, pretty close to 30% with the stocks I bought. It also reduces the best possible outcome, so it's less gambly and lower risk. So that's why waiting is so important. That's it. I've got other presentations that have a ton more detail. So if you're interested, have a look at those.